Hi everybody, this is Steve here from Sure Trading. In this video, I'm going to talk to you about 3 indicators that you can use in your trading which can help you to identify reversals in the market. If that sounds good to you, then please continue watching, but in the meantime, please like this video and subscribe to our channel if you haven't already. And in the description below, you can find links to our website where we can talk to you about our mentorship program, as well as a link to our free Telegram channel where we share trading content, tips, and advice. So let's get straight into it. Okay, so the first of the 3 indicators that I want to talk to you about is the Stochastic Indicator. Let's just get it open here on my chart. So there we have the Stochastic Indicator. The Stochastic Indicator is a range-bound indicator, meaning that it always moves between 0, which is at the bottom of the chart over here, and 100, which is at the top of the chart over there. It cannot go higher than 100 or below 0. This makes it a useful indicator to show you overbought and oversold conditions. So traditionally, readings over 80, which is this green line over here, are considered as overbought, and readings underneath the 20 line, which is this line over here, are considered oversold. So the concept of support and resistance dictates that when a price reaches an extreme overbought or oversold threshold, it'll reverse. So for this reason, overbought stochastic readings, which are the ones at the top above this 80 line, are generally signs that if it starts going downwards, the price will reverse. And similarly, if you get oversold indicators at the bottom, so these ones below the 20 line, and then it starts to move upwards, that's generally an indication that the price will start moving upwards. So basically, the stochastic helps you to see whether prices are exhausted in either direction, and if they start moving in the opposite direction, that's generally an indication that the price will follow suit. So that's the stochastic indicator. I'm just going to minimize it for you while we get to the next one, which is the MACD indicator. So the MACD indicator is a slightly more complicated indicator, but we don't really need to worry about the details of how it's all calculated. So MACD doesn't stand for McDonald's, it stands for Moving Average Convergence Divergence. And it's a trend following indicator that shows the relationship between 2 moving averages of the price. So depending on the periods of the moving averages selected in the settings, in this one we have an 8 and a 17. The MACD line is calculated by subtracting the 8 moving average from the 17 moving average, and then it's plotted over here, and then a 9 period moving average is added to the chart, which is then called the signal line. Now when these 2 lines cross, they can be used as either a signal to go long or short. So if we have a look over here, when these lines cross downwards over there, that would be a signal to go short. And then when they crossed upwards again over there, that could be a signal to go long, and another signal to go short when they crossed downwards at the top, and long again, and vice versa. And if you look at this green in the middle here, this histogram, when these lines cross, the histogram moves into the opposite direction. So you can see it was below the 0 over here, and then when these lines crossed over there, it went above the 0 until they crossed again downwards, and then it went below the 0, etc. So if you just look quickly at the MACD, you can see which direction the market is trending in by seeing where the histogram is, whether it's above or below the center point over here. So that's the MACD. Now the third indicator that I want to talk to you about is the exponential moving averages. Now if you've watched my previous video on moving averages, you'll know that a moving average is the average of the selected period of candles, and it's plotted in a line as a line on the chart. So let me just add a 3-period moving average over here. So you'll see this line in blue over here. So this end point over here is the average of the last 3 candles, because it's a 3-period moving average. So you take the price of this candle, this candle, this candle, you add them together, divide by 3, and you get a value which is the last point over here. If you want to go to this point over here, this point on the moving average will be the average of the previous 3 candles. So it's those 3 candles added together and averaged out. So that's an exponential moving average. And what an exponential moving average does, it helps to smooth out the movement of the price so that you can see what trend the market is in. This is a very fast moving average, so it's very similar to the price. And right now we're going to add a second moving average, which is a slower moving average. This is a 15-period moving average. You can see that over there in red. Let me just zoom in so you can see it a bit better. And the idea behind this is that when these 2 moving averages cross, that is an indication that it is a good time to either enter long or enter short. So if we have a look at this area that we're on the chart at the moment, when these moving averages crossed over here, they crossed in an upward direction, that is a signal for you to potentially enter a long position, because the price might be moving upwards, and you can see that it happened nicely in this example. And then they crossed over again over here in a downward direction, meaning that it's a good time to enter a short, and you can see that it worked out nicely over there. Now, the thing with indicators is that it's never advised to use just one indicator, and that's why I've shown you these 3 indicators. So we put them all together and they give us a good indication of whether the market is going to be changing direction. So let's have a look at a couple of examples by adding all of these indicators back. So you can now see the MACD at the bottom, the stochastic in the middle, and the exponential moving averages on the chart. So let's go a little bit back on this thing and let's see how we would use these to enter a trade. So firstly, I'm going to start around this area over here. The first signal was the stochastic, which crossed upwards. So it was in an oversold position, and it's now crossing upwards through this 20 line, which is an indication that it's possibly going to make a reversal. So that's the first indication over there. If we go a few days on, we see that the MACD then crossed upwards over there. So these 2 lines crossed and the histogram went above the 0 line. So that's the second indication. And then finally, what we're looking for is the exponential moving averages to cross, and that happened over here. So I would say a good time to enter would be on the following day, which is about there, and you would enter long. And in this case, it worked out really nicely for you, and you had a nice bull run up to about there. Let's have a look at another example in a downward trend. So the first thing that normally happens is the stochastic turns downwards, and that happened over here. Pretty much at the same time, on the same day, the MACD turned downwards. As you can see, the histogram went into the negative, and a few days later the moving averages crossed, so you would enter around about there. This one wasn't as successful, but you could still have made a bit of profit in this little downward move until it changed direction, which you could have seen by the stochastic, which turned up over there, followed by the MACD, which turned up over there, and finally the exponential moving averages, which turned up over there, and you had a nice bull run over there. So there you have it. That's how you can use the MACD, stochastic, and exponential moving averages to find reversals in your trading. I hope you found this helpful. Like I said earlier in the video, please like the video, subscribe to our channel, and share it with your friends. And as always, visit our website, suretrading.co.za, to find out more about our mentorship program. Thank you so much for watching. Cheers.